Hey, good afternoon. Robbie Gardner, Atlantic Bay Mortgage, coming to you with a quick market update for this week. Interest rates are a little bit better today than they have been earlier in the week. Inflation reports came in that weren't as bad as they had anticipated, which has created a reaction from the bond market to be more in favor for mortgage rates right now. Another thing to consider is with that report coming out, it's anticipated that the Fed was likely to increase their Fed funds rate by an additional 75 basis points as they did in July, as they did in June. But now they're thinking maybe that's only a 50 basis point increase because maybe inflation is slowing down. You've seen gas prices coming down a little bit. Some of that's because we've released reserves and other tax holidays or other things that may have been consideration. But summer holiday travel is over, and so you might see those gas prices come down. But how does that affect us? Again, a couple weeks ago I said a $200,000 average loan amount for every 1 point or 1% increase in interest rate from 4%, 5%, 6% is an additional $125 a month in principal and interest, really just interest payment that borrower would have. So a jump from 4% to now closer to 6% is about a $250 increase max on that $200,000 loan. Interest rates have come down. We're looking more around the mid fives at this point. But something to keep in mind right now as that market shifts, and I'm assuming that you guys have seen a shift in the market, is right now it's reported that consumer credit card balances is at an all-time high. Those had went down during COVID because people weren't going out and people got free money from the government in the form of checks, and so they were paying down debt. But right now, with inflation kicking up this year, people are putting more on their credit card and not paying them down. So balances are at an all-time high for credit cards. The rates that the Feds increase, that directly affects credit cards. That directly affects equity lines. So what does that mean for you? Well, as a realtor, you'll see other people that may need to sell their house to tap into equity in their home to be able to pay off some of that debt. Hopefully their job remains the same. They're not going to be out of a job, but should they fall on hard times or need to, again, tap into equity in that home, then you should be able to see some more listings involved. For me, it means possibly more people might refinance. Depends on when the last time they refinanced, but possibly a cash out refinance would be the best option for them and keep their home. But again, something that you and I both would need to keep an eye on. And with that said, I have a new program that I'd like to reach out to you each individually as realtors to talk about how you can talk to existing clients and my existing clients and possibly future clients about equity in their houses or what the market is doing. It's called HomeBot. I'd love to, again, set up a one-on-one time with each of you to show how we can each benefit from this program and talk with our clients about equity in their home, what the market's doing, and give them some options should they refinance or if they look to sell their house. Again, reach out to me with any questions. Robbie Gardner at AtlanticBay.com. Send your clients to RobbieGardner.com for mortgage applications. And I look forward to talking with you soon. Maybe try to schedule something to talk about conversations we can have together with your borrowers. Have a great day, guys.